Welcome. In today's session, we'll explore real-life case studies of investments in Kenyan financial instruments. These stories will highlight successful investment strategies as well as common pitfalls and how you can avoid them. Learning from real-world examples is one of the best ways to sharpen your skills and make informed decisions. Let's begin. 1. Successful investments in Kenyan financial instruments. Case Study 1. Investing in Treasury bonds for stable returns. Background. In 2015, Mary, a risk-averse investor, decided to invest Kenya shillings 1 million in a 15-year infrastructure bond issued by the Central Bank of Kenya. This bond offered a tax-free interest rate of 12.5% per annum. What she did right. Researched the opportunity, Mary carefully read about the bond and confirmed its tax benefits and interest rate. Chose a long-term horizon. She was saving for her retirement, making the bond's long maturity a perfect fit. Used Treasury Mobile Direct (TMD). Mary leveraged the CBK's platform for direct investments, minimizing costs. Outcome. Mary now enjoys semi-annual interest payments of 62,500 shillings, providing her with a reliable income stream. By the time the bond matures in 2030, she'll have earned a total of Kenya shillings 1.875 million in interest, nearly doubling her initial investment. Case Study 2. Capital gains from shares. Background. In 2012, James, a tech enthusiast, purchased Safaricom shares at 3 shillings and 50 cents per share. He invested 100,000 shillings, acquiring approximately 28,570 shares. What he did right. Identified growth potential. James believed in Safaricom's long-term growth due to its innovative M-Pesa service. Held his investment. He avoided selling during temporary market dips and held the shares for a decade. Outcome. By 2022, Safaricom shares were trading at around Kenya shillings 40 per share. James's investment grew to over Kenya shillings 1.14 million, yielding a return of over 1,000%. Additionally, he received dividends annually, further boosting his earnings. Case Study 3. Low-risk liquidity with money market funds. Background. Grace, a small business owner, wanted a secure place to park her emergency savings while earning better returns than a standard savings account. She chose a money market fund, MMF, from CIC Asset Management in 2021. What she did right. Prioritized liquidity. Grace could access her funds within 48 hours if needed. Compared providers. She selected a fund with low fees and a competitive annualized return of 9%. Outcome. Over 2 years, her shillings 200,000 investment earned her approximately shillings 36,000 in returns, while her principal remained intact. 2. Common pitfalls and how to avoid them. Pitfall 1. Lack of research. Example, Peter invested in a corporate bond from a struggling company offering unusually high returns. The company defaulted and Peter lost his money. How to avoid it? Always research the issuer's financial health and track record. Stick to investments regulated by the Capital Markets Authority (CMA). Pitfall 2. Emotional decisions. Example, and bought shares in a trending company without understanding its fundamentals. When the share price dropped, she panicked and sold at a loss. How to avoid it? Focus on long-term goals and avoid reacting to short-term market fluctuations. Diversify your portfolio to spread risk. Pitfall 3. Ignoring fees and costs. Example, John invested in a money market fund without checking the expense ratio. High fees ate into his returns, leaving him disappointed. How to avoid it? Compare fees across brokers and fund managers before committing. Opt for low-cost options where possible.